this whole thing work? Mr. Computer, please.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. How's it going, everybody? Having a fun day? I tell you, I'm not, because this is the first day, seriously, this is the first day in ages I didn't have a short on the indexes because I got fed up with it because I was getting burned every day. I was short, we had little wins, but nothing good. And today I was like, oh, screw it. I'm so sick of getting burned on the shorts. And what do you know? Boom, we go up. But meanwhile, the best setup at the moment is actually going long at 1600 here because so far, we haven't seen a sell-off that's been, this is a Russell, by the way, TF. There hasn't been a sell-off that hasn't had a really quick turnaround. So, since the only thing I really saw that knocked the market down were just comments from Davos and questions about Apple's quarter that started the NASDAQ tumbling, it wasn't really like, I don't know if it's going to be sustainable. So I don't mind playing a little bit. We'll still see what happens. We'll take a contract here with a stop below the 1600 line. But that's a good place to put your foot down for a bounce, at least. And if it fell from 1620 to 1600, that's 20 points. So you expect a weak bounce of 20% of the fall. So 1604 would be our immediate goal for a weak bounce. And then 1608 would make a strong bounce. And then you just got to keep your eye on everybody else to see if they're bouncing. So this is the Dow, the NASDAQ. Let's just do the S&P. So the S&P is a little bounce off this green line, so we want to watch that line. The Dow is not doing anything, and the NASDAQ's not doing anything. We want to see the NASDAQ get back above this green line, to remain bullish. And again, there's no conviction of the bullishness. I'm just expecting a bounce at this point, so it makes a fun place to play. I got my first bid in at 1600.6. So if we come back down to 00, I think I might poke another one and see what happens. Then my average will be 03. So my goal here is to get one at 1600. Probably not going to happen, though, I'll tell you. Because if it's going to hold up, then it probably won't even test 1600 again. But so far, it's not looking like a very strong bounce. But on the futures, the key to any good entry is finding a good stopping point. So you always want to enter above a good stopping point. So on this line on the S&P, call it 2830 is a line that you could play because it's a good strong line. It's got support of a retrace. On the Dow, it blew past its line, so that's no good. On the NASDAQ, it's under its line, having trouble getting back over. And here we are. Oh, man, but it's going the wrong way. So I'm not going to add one. I'm going down and down. I'm not adding one right now because I don't see stability in any of these guys. They're all kind of red. But, All right, now they're firming up a little bit. So let's see. All right, so I'm going to do what I wanted to do. Let's add one more. Now my average is 16,150. So I already know. Now I have two long of 16,150. So I already know at 16 here that I want to get out. As I'm putting in my sell order here, if we get a pop, it'll automatically bring me back to 1, but back at the basis I really wanted to be at, right at the 1600 line. And we'll just see how this one goes. You can. It looks like, frankly, it's consolidating for a move further down, more likely than it's going to go up at this point, because all these guys are not even making a weak bounce. So we might have to take a quick loss on this one. Oh yeah, look at that. Look at the NASDAQ. Now that being the case, my next move would be to go short the S&P as it fails this green line. All right. So in other words, if this thing fails, my next move is going to be to probably look at the S&P for a short, assuming the Dow and the NASDAQ are making new lows. But there's no particular thing that's causing the Dow to drop, which is why when you lack a particular reason for something to move, then you assume it's going to bounce off a technical. It takes usually some kind of data to get you off a technical. I mean, the biggest news I see that happened recently is, oil popped 65, although it's back down now. And that's obviously not the best thing for the consumers. But no, he's getting weaker. He's not looking good. He's down here. So I guess this trade's not going to work out, unfortunately. I'm kind of waiting for this guy to hit 28.30 and see what happens. I don't see this plowing through on the S&P. That's the other thing you have to keep in mind when you plan the futures. You have to keep in mind that the Russell is a silly index. It doesn't mean anything. The Dow is a completely ridiculous index. Any single component on the Dow can make it move up and down a lot. So you can't tell what's going on with the Dow either. So it really matters, basically, what is the NASDAQ doing? What is the S&P doing? And if you look at them closely, let's see if we can zoom in a little bit. They're giving you kind of an identical move. See, that's the same. It's the same computer program basically trading both of them. There's no humans involved here. This is you see how it comes down, does that, comes down, does that, comes down like that, comes down like that, goes up a bit, consolidates, come down, and here, and the only difference is that the NASDAQ's a little below the green line and the S&P is right on the green line. So we're looking to see if the S&P fails 28.30. Which it's doing right now, frankly. Oh, wow. I should have hit it. Nope, looks like, no, see, he's coming seriously below, so you got to get out of this one. Whoop. Wait a minute. Cancel. Didn't take my order. Not good. I'm just waiting. I'm watching this guy to see what the NASDAQ does over right at this spot to see, because that's where it bounced last time. But the S&P is not looking good. 28, 28, 25. So it's 2 points below where I wanted to short it. I would have actually made my money back if I stuck to my guns. No, NASDAQ's looking terrible. It's not going to work. Going so fast. There's one out. And two out. Wow, lost 340 on that. That's awful. So I missed my shorting opportunity at 28.30. But it is looking bad. And now the next confirmation you get that something that's getting worse is if the Dow fails its line at 26,111, I guess, or whatever. This is not good, though. Look at this. Holy cow. The NASDAQ is going to test its lower support line at this point. So go, basically 6,900. If 6,900 doesn't offer support, you can bet they're all going to go down further. Wowee. So then, see, 6,900 is a place you'd expect to bounce off the NASDAQ. And the S&P is hitting right at its level. So if I was going to play long, I'd rather play S&P because it's got the support line to play. But none of these guys are looking very strong right now. Going to have to see. Now look at that. See, he failed already. He's failing his line. The S&P's holding its line for now. But now, it doesn't mean that you're wrong about the thing going lower if the S&P bounces off a support line. It's supposed to bounce off a support line. The question is whether it bounces strong or weak off that line. Now in the S&P, not the S&P, this is the Dow. So in the Dow's case, we're from 26.4 to 26.1 is what, 300 points? So we'd be expecting a 60-point bounce. Now there's not even resistance at 26.160. There's 26.160. They see this tiny bit of sort of support over here, but barely any support at that line. And above that's going to be 220. And again, you can see that 220 is this line up here. So your bounce lines for the Dow are that would be the strong bounce, and this is a weak bounce down here. And we're not seeing much of it so far. But here's the Russell coming back, so let's get back in that. I think I was right originally. I think there should be a bounce, but we'll see. Just a little panic selling at this point. All right, so now I'm back in too long at 9976, which is right there, but I was down 360, so I have to get up past 16 just to get even at this point. All right, so we'll check back on this, but that should be it, because it's very rare that an index is going to blow past its second support level, any index. So if the NASDAQ gets there first and it starts bouncing, everyone's going to bounce anyway. And like I said, the Dow's going to have, in theory, a bounce up to 25,160. And that means this guy, who's fallen now 22 points, still a 4-point bounce. So a 4-point bounce will take me to 1602, in which case I'll be in the green. So we'll see what happens. That's my theory at the moment. Subject to change, obviously. All right, questiones. Yep. Down. Oh, Wilbur Ross made trade war comments. Yeah, these guys. See, this is a problem when you have an administration that's proud to be a bunch of guys who shoot from the hip, because government is not about shooting from the hip, because everybody reacts to whatever these people say. All right, so what did Wilbur Ross say? That's the question. So let's take a look over here and see if we can find out what Wilbur Ross did say. Now, what time is it? It's 1 o'clock. Oh, yeah, so it's like dinner time over there. Wilbur Ross. Nothing here about Wilbur Ross. R-O-S-S. Bill Gross. Nope. Okay. So now let's check out Mr. Twitter. What? No tweets yet. Search Twitter. Wilbur Ross. What did he say? Nope, that's not doing it. Search Twitter. Probably better off just doing general search. There we go. Wilbur Ross, Wilbur Ross. How do we do this? Filter, show, top news, view all. How do you make it show you the most recent? View all. Oh, here you go. Wall Street mood cools after Wilbur Ross comments on China. What does he say? Wilbur Ross called China's 2025 technology strategy a direct threat, hinted at action against Beijing. Oh, nice. Speaking at the economic conference, Ross said they're investigating whether it's a case for taking action over China's infringements of intellectual property. Oh, come on. That's been going on for ages. I would lean to vote. All right. Well, look, we're technically overboard. It doesn't take much to spook the markets at this point. And apparently that's what happened. Just any comment could have done it, but that's the one that did. Now the question is, how seriously are people going to take it? Is this just a few people panicking out, or is it going to turn into a thing where people say, oh, time to sell this market? I don't see it, because we've been talking about this intellectual property crap with China forever. So it seems like kind of an odd thing to suddenly tank the markets on. Meanwhile, though, here's a great object lesson. Oh, thanks. Yeah, too bad that link doesn't work in the thing. So meanwhile, let's see how portfolios are doing. This is a good time to talk about what the purpose of a hedge is for. So in the options opportunity portfolio, I'm not sure when this was last updated, 1247 apparently, which was only a half hour ago. Let's take a look if we can. I'll refresh the screen. I guess I can do that. There you go. All right, so now we're only up 3.3%, but the point I want to make, so we lost 1%, and of course, if everything's pulling back and such, that happens. And also because we sell more premium than we buy, if there's a spike in the VIX, which I'm sure we'll see, yeah, look at the VIX spiking up. Since we sold a lot of premium, that's going to cause all the shorts that we sold to jump up. But the main point is that I want to make is the hedges. Here's TZA. And the other day, I don't have the last OLP, but I obviously, the other day it was either losing money, it was flat, it was probably losing money. We just rolled into this position yesterday on the adjustment. But all of a sudden, we're up 3,000, down 800. We're up $2,200 on this one. So obviously, that's saving our assets, right? Because we're only up 3,000 in the whole portfolio. 2,200 is from the hedge. And our other hedge is on the financials, FAZ, and that one is flattish. I mean, it's up a little bit, like 500, 600 bucks. But the point is, well, you say nothing. It's like 2,200 plus 600 is 800, 2,800 bucks. We're up almost $3,000 on our hedges. The rest of the portfolio is basically flat. So it's the hedges that are actually saving our profits right now. This is why we have hedges, and if it got worse, the hedges would start making a profit while the other positions lose money, and then we would take the money that we make on the hedges and use it to adjust the other positions, and that's what balancing the portfolio is all about. So I dread to see what happens in the long-term portfolio. The long-term portfolio is all bullish. Oh, and it's still up 5.2%, which is pretty good. So the long-term portfolio is up 5.2%. And basically, so this month we started on the 2nd. And the short-term portfolio should be doing well because the short-term portfolio is all hedges. Oh, it's only up it's up 1%. It's because of the offsets here, these guys. But what do we have in the short-term portfolio? We have the DIAs, and those are still down. Oh, well, I see. And the SVXY, I see that it's a different choice because we use the VIX hedges. The short-term VIX short puts are actually causing loss at the moment, but we're going to roll out of those. That'll be fun. That'll be fine to manage. It's the Dow hedge we're more concerned about, and that one's going to pay off if the Dow's below 260. And right now, DIA is below 260. It's 261 at the moment. So this will turn into a very large positive if the Dow actually goes down from here. Meanwhile, we paid for these hedges with these short puts, which are essentially neutral at the moment. But these can start hurting us if there's a really big sell-off. Oh, and Tesla turned positive. How nice. That was hurting us also. So the Tesla's turned positive on us, and that's a good thing. All right, so all is well. This is a good-looking portfolio. And we have a butterfly portfolio. We finally put a trade in it. It's down at the moment, 0.3%. It's down about $300. And that was OIH. And here, you know, look, we just wanted to stay between around 29 to $30, and we're going to make money. So it's just about 29 right now after dropping 50 cents today. So it's really going to be a matter of just waiting and seeing what happens. But we're pretty good. The long-term portfolio is $500,000, and it's protected by the short-term portfolio. So the short-term portfolio is only $100,000. It's a smaller portfolio, and our goal is to be aggressively bearish whenever we feel the market has a problem, because that's where we look to make our money. These are the hedges for the long-term portfolio, although also in the short-term portfolio, we do take occasional short-term opportunities, and also these longs are the offsets for these trades. So in other words, we take these trades that are hedges, and then we pay for them using these short puts. Now, if any of these short puts actually went in the money, and we decide to stick with the position, rather than, well, not rather than, we would take the loss in the short-term portfolio. You know, so let's say ABX drops to $12. So ABX is $12, and we would owe $3, $3.50 back on the puts, whatever, with the premium. So we're down $1.50. Not a big deal, obviously, but so down $1.50, which would be $1,500. We would take the $1,500 loss here, but we would transfer it, not transfer, but in the long-term portfolio, we would then open up an ABX position, assuming we wanted to, that would start at $12. So in a way, that's how we kind of transfer money from the short term to the long term. We take a hit in the short-term portfolio, losing some cash, and then the long-term portfolio establishes a position that we have a loss on in the short-term portfolio, and establishes a new position, and it benefits from the bounce. We did that over and over and over again in the previous paired portfolios, and that's essentially, basically, we're in the long-term portfolio. We don't start it. We initiate a trade after it's already taken a big hit. So we used ABX as Barrick Gold, CIM as Chimera, a REIT, IBM, obviously, IMAX. We like them also for an offset. NLY is another. It's actually it's the same companies, the same management teams, two different companies, but it's the same exact management team as NLY and CIM. So this is two plays on the same company, effectively. And then there's SKT is Tangier's Mall Outlet. They're a really quality outdoor mall operator. So we like them a lot. We think they're gonna come out well. Oh, speaking of which, all right, let's see if we have any questions before I do my speaking of which. Oh, you want you to be paying some attention. Yeah, let me get another. All right, hang on. I get my bounces. Oh yeah, there we go. Much better. All right, so now if you wanted to add something, playing the NASDAQ over the 69 line with tight stops. Wow, look at it go. Playing the NASDAQ over the 69 line with tight stops as it flies up is the way to go. Now me, I'm still down, and I see the NASDAQ flying, so I may as well add one here, right? Why should I only have two if the NASDAQ's going to be popping up like that? Everybody's popping, so the Russell is lagging. So now I have three long. We'll see what happens. Anyway, all right, so what's going on here? Any thoughts on adjusting 10 short calls for HMNY? I don't think so. Why would we want to do that? HMNY. Oh, because they pulled back a little? No, this makes no sense. I guess that must be is that in the OOP? Where is that? You can't see it, but I'm moving. I gotta move this question box. All right. That would be, I guess, in the OOP. And what was that position there? Nope, it's not in the OOP. Okay, it's in the LTP. There it is. All right. Wow. What is that question about? I don't understand. Any thoughts on adjusting the short 10 calls for HMNY? All right, let's talk about this, Brendan. No, that's not what we do at all, especially in the long-term portfolio. We sold 7 August 750 puts for $3.50. That means that we're willing to pay $7.50 to own HMNY, which is currently trading at 10. If HMNY is over 10 in August, I'm sorry, if it's over $7.50 in August, they'll expire worthless, and we'll keep the $3,500. It's at the moment it's on track. Under no circumstances I would have no reason to adjust it. It's up $1,000, which is nice. I know. If you're new to this, it's weird that you're up 28% in a position in like 2 weeks, and you're like, well, not 2 weeks. I'm sorry, we bought this on the 16th. What's today? Like the 23rd, 24th. So 8 days ago. So 8 days ago, we sold these puts, and they're already up 28%. But that's normal. This is what we expect for returns and options. I know it's crazy, but this is a perfectly normal situation for us. We make this kind of money all the time. So and then we also have the spread, and the spread's doing gangbusters. This position was great. This is those movie pass guys. Didn't we do this like last week at the webinar, right? We talked about this. What happened is, I see. This is a weekly. I was looking at the wrong one. Oh yeah, so they're going up and up. So last week, I read in the news. Now we've talked about them plenty. It's like I was telling people that I couldn't get my head around their model. I couldn't get my head around their model to understand, like, how are they supposed to make money? I thought it was like kind of a scammy sort of thing. But a couple of things came up. The thing I liked the most was that they're getting a $2 kickback from the movie studios. So the movie studios, you pay them like a gym membership and you get to see movies, but it's not unlimited. I found that out. If you want to see unlimited, it costs a fortune. The basic thing only allows you to see like a couple of movies a month. So they're not on the hook for that much. And they're getting a kickback. They're getting a discount from the movie theaters on some of the movie theaters, and they're getting a kickback from the movie companies. The studios are paying them when they send people to their films. So they're winning 2 ways. Plus, they're getting bonuses for advertising and promotion. Like, they're getting deals from the movie studios because they have this captive audience of millions of people who like going to movies. What they do is they'll incentivize them to go see a certain film. Like, they'll say, bonus film this month, go see this one. And that sends a certain amount of people to see a film, which counts in the attendance for the movie company. So they get to say more people saw it. And it also gets more buzz on the social media. So if somebody thinks they have a really good film, like that Shape of the Water thing, right? Which, like, nobody knew what the hell it was, but it turned out to be a good film. So if people want to promote a film, if the movie studio thinks they have a good sleeper film that's not getting enough buzz, they can now take an audience and imagine that they can control an audience and move it around and put it in theaters and sell it. And that also helps them get more theater owners on board, because they see a whole bunch of people coming in to see a certain film. So they might add a screen, and that helps them also. There's a lot of good stuff in this, in having this audience that, the movie pass people can effectively send their audience from place to place to go see things, and that's really powerful for an audience, an industry that completely lives off having an audience. So I see good potential here. I understand how their model can make money, and now I see a really good future trend for it, because I think they're going to pick up. I think they'll be Netflixy, like growing. They're going to add probably a huge amount of subscribers, especially as kids start talking about it and it starts spreading. Like I know my daughter and her friends are already starting to talk about Movie Pass and things like that because some people have it and they're all like, "Oh, I get to go see a movie. It doesn't cost me anything because it's already paid for." You know, and that's very appealing to the kids. So anyway, so I think these guys might have been right. I think that it's probably good for the 20s, and it's only at $10 right now, so I still like them. But point being, anyway, so all we did last week when they were down at 8 is we promised to buy them for $7.50, but we got paid what was that? It was a ridiculous amount of money. We got paid $3.50 to promise to buy them for $7.50. I mean, that's just crazy. Anytime you get a deal like that, unless you think the guy's going to go bankrupt, you take it. So anyhow, so that's where we are. So fantastic deal, great returns. I mean, the net cash outlay on this was negative. We had a $1,000 credit, and now we could cash it in for, well, let's see, 10 minus about 5,000. So we're up about $4,000 in a week, and that's great. But now, how much are we supposed to make on this trade? This is a spread from 5 to 10. So we're going to make in August. We're going to get $10,000 and we'll be up $11,000. So far we're at $4,000, but we have $7,000 more to gain by just leaving it alone. We leave it alone, and these guys stay over $10. We're going to make another $7,000. That's a good spread, right? That's how we like our spreads to work out. Oh, how's Chipotle doing? That was one that was hurting us. Oh, that's coming down nicely. Good. We sold the 310 puts for $15, and they're 30 now, but Chipotle's only at 328, so these technically are $17. It's just the rest is premium. So it gave us a big scare. It really, I mean, Chipotle went flying up, and that was hurting us in the long-term portfolio. And see, that's the thing. When there's a market sell-off, there's good and bad things that happen to us when something goes up and down. In this case, look at that. We were $20 more in the hole on this thing, but it's calming down. And our target is still around here. We don't think there's any particular reason going to be much over the middle of this channel. And in the middle of this channel, we got no problem rolling the short calls along. So there's that. How's my index doing? All right, look at that, 285 profit. That was nice. Gonna get rid of that one. I think, see, now we're hitting the 1602 line, so why should I be greedy? Gonna take another one off, if I get it. Nope, bastard. There it goes. Let's see. I should be thrilled. So I'm up 250. I was down 350. Nope. See, I don't like the action over here. It's hitting the resistance line. So you can expect a pullback, but I'm up a quick 255 now. So why should I mess around? And again, it's a fresh horse. If this guy blasts over, who's going to be the next guy to cross? Well, then clearly the next cross is going to be this one. So then if he crosses over, then the next one. But you see how we played that? I took the loss, I got out, I waited, I saw the setup looks a little bit cleaner. I got back in pretty much where I got out. And then I added one more because as I saw the other guys taking off and the Russell was lagging, I added one more because I said, what the hell? I'm in for 2, I'll be in for 3. But it looked like it was just being slow to move off the gate. So now we're at this line. Since it's resistance, I said, why don't I just lock in the 250 gain? If it gets over that line, I can go long again and use that line for a stop. That's one thing. If I were going to stare at it, but I'm not because I don't have time to stare at it right now. But if I were able to stare at it, I would certainly use that line as a stop. If it takes off past this line, the next one I look for is this line to go up. But everybody's doing the weak bounce that we expected. So, remember 60 was the number? Where was that? Oh, it was this guy. So he's at 152 now. So we'll see how they do at 160. That's the weak bounce line. And this is just a 5% rule. All we're doing is applying the 5% rule, and that tells us what things are going to do. You don't have to wait for things to actually happen. You can predict them in advance. it looks like things are taking off. So I'm sorry I took out that guy. But like I said, it was based on the fact, remember I said if we cross this green line, that would be your next fresh horse that you want to jump on. So basically, I guess we'll call it, I call it 26. So right here, across this line is where you might want to play the NASDAQ long. Oh, shit. It just flew up. Look at that. I missed it. All right, well, whatever. Less explaining, more trading. Wow. Look at that. Oh, and now it's back again. Wow, this is crazy. No, I don't like that. I don't like it when it moves up and down that crazy. All right, so now I'm going to move to the S&P, which has a good line, the center line on the S&P, and that's 37. So that's another one you can play above that line. So now you say as long as the Dow holds this strong bounce at 26,160, you can use that. But now you've got this 27 line you can watch over here, the 26 line. You can watch the 37 line over here. You got the 1603 line here. You got all these different lines that you can watch. And as long as two of them go over, you pick the third one up for long. That's all. You just pick up the one that's lagging and then use that line as a point of resistance. Since none of them look particularly strong here, and we know that's the weak bounces that we expected, I don't like them long on this leg, which again is why I wanted to take quick profits over here, because they're all running into resistance. So now you'll see how much they pull back from the resistance. And you can actually run the calculation again. Now we can run the calculation from here to here and take a 20% retrace as weak and a 40% retrace as strong. And then if it holds the weak retrace, it's probably consolidating for a move back above the line. See, simple. Anybody can do this. Phil, can you talk about when you would take profits, losses, adjustments on hedges? I have some that made money quickly, but I felt I should hold them to protect further downside. And then they turn the other way. Yeah, a hedge is a hedge. So think of it like health insurance. Okay, like you pay $2,000 a month for health insurance, right, for your family, and it's a loser for 8 months of the year. So you get to August, nobody got sick. And you're like, son of a bitch, I paid $16,000 this year and nobody even got a cold. And then in August, somebody breaks their leg and it costs you the $10,000 thing in the hospital and all that crap, and they fix it, and then crutches and everything else. And you're in for like $15,000 and your health insurance covers almost all of it. So now you've broken even for the year on the health insurance. So do you cancel it? No, because you might need it again, right? The hedges are insurance. You're not supposed to make money on them. The only time you should make any real money on them is if there's a real correction. And in that case, you'll make a lot of money. And then you have to say, okay, I think that this sell-off is done, and now is the time to take the profits on the hedges. But only when you really feel that you've gotten a big payoff and it was maybe an overcorrection on the market or something like that. It's a judgment call. There's no rule. It can't say when this happens, that happens. But like, in March of 2009, there was a particular day when the market just collapsed, like went down and down and down, like relentless selling. And we made a freaking fortune on our hedges. And I just said, I was on TV at the time. In fact, I was doing a TV show live. And I told my guys, I'm like, that's it. Take the money. I'm like, forget it. This is stupid. This is a panic sell-off. It makes no sense. It's beyond what anybody should go below. The S&P was like 666 at the time, I remember, because it was 666. The S&P was hitting 666. And what is it now? 2,800. It's up 4 times. And it was just a ridiculous number. I mean, you just, assuming it was really worth 8, we went from 18 to 666 in that drop for, from like October till March. But 666 so then was 1/3 of where it was. And I'm sitting there on TV, I'm saying, look, did the global economy really go down 1/3? And you have to understand that logically, in the global economy, half the people in the world are farmers. You know, the people you see in the videos putting the jug of water on their head and carrying it to the village, and the guy goes out with to tend the farm with a bag of seeds and walks around throwing seeds manually. So they don't even have an ox or anything like that. That's what half the world is like that. So those people are maybe, per capita GDP like 2,500. But there's, 3 billion of them at least, or almost 4 billion of them. So let's say there's 3 billion of them. You're talking like 60, I'm sorry, say 6 times 2,000, 6,007. So it's about let's say $9 trillion of GDP is people like that. Then you've got the basic middle class and the people in India and whatever, and people in China who make $10,000 a day, and there's a couple of billion of those people, and those people are $20 billion worth of GDP, 20 trillion, sorry. And so when you look at the base, there's a certain base to the GDP. That's not going to change. So if you figure subsistence living, that all 8 billion of us on the planet are good for $5,000, on the average at a subsistence level, forgetting all the commerce and everything else, that's $40 trillion. Okay, everybody on Earth making $5,000 a year in turnover and GDP, and I'm talking dirt farmers are good for 2,500 at least. So, so believe me, the global average is over 5. I think the global average is around 8. Actually, but let's say it was 5. You're still talking $40 trillion out of 100. Therefore, any market collapse that takes you down 2/3 below 40% makes no sense, because literally we could all wake up tomorrow and have sticks and rocks and so on and so forth, and we're still going to be a $40 trillion economy. Your job could be gone, every factory could be gone, the U.S. monetary system can be gone, but at the end of the year, when they use the abacus to figure out what the GDP is, they will still come up with a figure of about $40 trillion as everybody goes back to being cavemen. So that's just a function of having 8 billion people on the planet. So there are actual bases that logically can't be broken. And when the market sells off to such an extent that it would take a global nuclear wipeout just to get to that level, that's when it was time to buy. So that's why at the time I was like banging the table. I made 13 calls on TV live at that time. I remember that. And it was stupid stuff too. It was like GM at $5 and Ford at $2 and Bank of America at $2. It was like, there were things that were just ridiculous. And it was incredible. I said whatever it takes. So of course we cashed in all of our short positions, all of our hedges, and we used that to go bargain shopping. We picked up all these stocks. That's the way you play the market. That's what your hedges are for. They're not for making 10% or 20% or whatever like that. The hedges are for making serious money to alleviate the pain of your long positions. And if you take them off early, what do you need? Don't you still need a hedge? The only reason you take them off is if you think it's ridiculous to have a hedge. When the market was down, like I said, when the market was down 66%, and I said that's not even possible on a global economy, that's when you say it's got to be time to stop hedging. So you have to use your head. You have to think sensibly about how much of a correction is this, how much more correction is likely to happen, what else could go on. Meanwhile, I could have been playing this stuff because we're getting a big bounce. But anyway, you get the idea. So like I said, so now we have, see, 2 are over. Well, let me play it because now there's 2 over. So we go long on the one that's not over, which is the S&P, if it'll fill. Oh, come on. Teaching a class here. Really? Really? That is petty. Fine. Hello? Oh, come on. This is so obnoxious. For some reason, I don't know why the S&P and the NASDAQ don't give me the little thingies, which I like. There's little boxes that tell me if I can bid. All right. Here's a good rule of futures trading. Don't chase. I didn't get my prices. I'm not playing. Screw that. But the point was to go long at this line because he was the last one to go over the line, and therefore I expect him to start catching up. It's not complicated. And then you just play him, and if any of these guys fail their line, you get out. So you make $50, $100, whatever. All right, anyway. All right, so hedges we talked about. The 20 short calls, Harmony. Any thoughts on adjusting the short calls? Oh, I'm sorry, the short calls on Harmony. No, it's the same thing on well, not Harmony, whatever the name of those guys is. I don't even know. I just know they're the Movie Pass guys. No, I'm not adjusting it. That's greedy. Now you're talking about like you want to adjust the short calls because you think you're going to do better than where it is. No, it's fine. It's going to make $11,000 freaking dollars. We had $1,000 credit. We're going to make $11,000 by August. You're not happy with a 1,100% return. I can't help you. I'm sorry. I cannot help you if you're that greedy. You just got to leave things alone. Look for the next opportunity. Consider it a win. Free up the allocation block, right? We talk about the allocation blocks. You say that allocation block seems fairly safe. I don't believe I'm going to lose any money there. Therefore, I can now allocate another $10,000 to another new position. That's also now find another position that we can make $10,000 on. Don't keep trying to make more money out of the same position because all you're doing is increasing your risk exposure for no reason. We have more, you'll get used to it. We have ideas like this every day. We have every single day, we have more ideas. So we're not like, we don't take one idea and beat it to death. We let it go, we take the win, and we move on. I need some guidance. OOP, Sun Power positions really leaking and taking losses. Oh my God, May, the Sun Power position is leaking and taking losses. Let's take a look. Now, Sun Power is down because they're going to be adversely affected by the tariffs. And so they took a big tumble from here, right? When Trump announced the tariffs, it went all the way down to 760. Now, May says she is taking huge losses in the OOP. What is happening? Well, we sold 20 of the 2020 $7 puts for $2.30. That nets us into the position for $4.70. The Sun Power is currently at $7.50, so it is $3 or about 75% above our break even. It is currently showing a loss of $230, but frankly, I can't even get a teeny tiny bit worked up about that. First of all, I would really like to own 2,000 shares of Sun Power for $4.70. That's fine with me. Second of all, though, I don't even think that's going to go that low. Now, the rest of the position is a January 7/12 spread. We paid net $1.60 for that spread, so we're looking at $8.60 is where we break even. It's $1 below that at $7.50, so our loss would be about $3,000 if we own the stock outright, if we had 3,000 shares, but we have a spread, and the spread is only down $1,200. So this part's down $1,200, and that part's down $230, so it's down about $1,500 net on the spread that started out with a 10, call that 11, started out as about $100, $200 cost on the spread. So this spread cost us nothing, and currently it's down $1,500, but it's still above 7, and anything above 7, we make money, and you've got 2 years to go. I don't know what you want to do. I will tell you though, look, honestly, if this kind of move bothers you, this kind of trading is probably not something you should be doing, because this is going to happen all the time. in options and in stocks. So frankly, if you bought the shares, you'd be just as, if you had bought the shares, you'd be in the same position. But we chose to do with options, but it's only down $1,500. This trade, if it's successful, is going to make $15,000. So it's down 10% at the moment. You've got to have a tolerance to be down 10%. And 20% for that matter, because that's going to happen all the time. In fact, if it was down 20%, we'd probably be putting more money into it to adjust it to a more aggressive position. So this is normal. This is what happens when you're trading options. They go up, they go down, and sometimes they work and sometimes they don't. And you just got to, have sensible limits placed on each of your allocations for the positions. And try not to let any one position swallow you up. But this isn't $1,500 in a $100,000 portfolio is nothing. It's just something that we're going to watch. For the OOP subscribers, is there a way to replay the webinar that I missed? Yes. If you go to Phil Stock World every Thursday, generally on Thursday morning, they'll put up or sometime Thursday, I don't know when, but here, I'll show you. So on a Thursday, they'll generally put the webinar from the day before. So you can go back in history and see them all. And in fact, once you go to the webinar page, it's like we have a YouTube channel, and then you can see other webinars. So let's see if we can go back. Wait, that's not right. These are just my posts. Sorry. Let's go Phil Stock World. Yes. Tuesday. I'm sure I'm going to have to go back a week. This is why I always give my articles days of the week names, because it makes them much easier to figure out where you are when you're looking back. So Friday, here we go. Friday, Bitcoin article. Here you go. See? So this was last Thursday at noon is when it came up. So what they do is they put it up, and then they have a little index telling you like all the things we discussed during the webinar. And for live access to PSW, Phil's weekly trading webinars. Well, anyway, so I think if I click on this, let's see if we can go to the spot. Oops. All right. I don't know what happens if I do that. Oh, here you go. See Phil Stock World? I think we have it. If you click on that, it's like a YouTube channel.
One of the key principles we like to teach our members.
And then it says recent posts. So you can see all of our, see the webinars. You can see them going back. So that's our YouTube channel, which, I don't know. I guess that's what a YouTube channel looks like. I don't deal with the marketing stuff, so I have no idea what happens. All right. Anyhow, so there. I am not seeing the questions. Yeah, I know. Unfortunately, apparently people can't see the questions, and I don't think that's fixable. I don't know if Greg is still here, but I don't think that we could. I don't believe it's something people can see, which is why I read the question before I answer it. I think I got bad fills on the call spread. Okay, man. But either way, it is what it is. It's I don't know what your fills were. That would be helpful to know. But the point is that you're in a position. It's not really off track. It's in the low end of where we want it to be. But we got 2 years, and we know why it's in the low end, because tariffs were just passed and people are worrying. But in fact, we talked about this in chat just before the webinar. Where was our chat? Here, I'll show you. This is a SPWR. So Barron had asked me, are there any thoughts on the tariffs? And I said, they manufacture panels in the Philippines and are subject to import rules. So even though they do a vast majority of their work in the U.S., to move manufacturing to the U.S. would take 2 years to build, even ignoring environmental issues. And it's very capital intensive, like to build a plant and then wait for the return on capital of the plant and so on and so forth, which is why these tariffs are idiotic. Somehow we'll now file an exclusion request, so government forms, which is likely to be granted, and then the stock goes up again. So what they're going to do is say, look, We employ thousands of American workers. Our company is 90-something% U.S. based. Our patents are U.S. based. We came out of I think it was Berkeley, but anyway, all their guys came out of like Berkeley. They've got the most advanced solar tech in the world, and this thing is crippling their ability to export panels and take over and do world markets. And it's not having the effect it's intended for the tariffs. So that's going to be their argument, and often these things get waived. Tariffs are a big talk with the tariffs, but then they end up like finding exceptions for like half the companies that have them. Anyway, so it's going to take a while though, but over the next 2 years, it'll get worked out. They'll either get worked out because they get an exclusion, and if they don't get an exclusion, they probably will arrange to have more stuff manufactured in the U.S., whether they do it themselves or whether it's or whether they actually subcontract to somebody who manufactures, like Tesla, theoretically should be able to manufacture the panels for them if they've got this gigafactory. But who knows what Tesla really has? So there should be a way for them to get their panels made in the U.S. and avoid the tariffs. So it would be a short-term effect, and then they go back to their usual business, which is going gangbusters. So we just hang on to it. That's all. I'm new this month, David Hall says. Welcome, David Hall. Yay. Can you explain the rationale behind the current DIA hedge? I got the 20 bear put spreads, but why the 257 put? How does this play out in different scenarios? Wow. In different scenarios. It's like explaining 3D chess. But it is important for everyone to understand how that stuff works. So he's talking about in the short-term portfolio, I think, which is now at 1.6%. Go short-term portfolio. Why is that? Is the index is dropping again? No. Weird. Anyway, this is what we call a mattress play. And a mattress play is we layer these. Now, you won't see it yet, but it's a mattress play as in like the Princess and the Peas sleeping on a ton of mattresses. So each one is a layer. And so if the Dow starts falling, we would add another layer. So if it goes below 260, we'd add a 270, 250 spread, probably in a different month, but we'd add a 270, 250 spread, then a 260, 240 spread, something like that. We keep adding layers to the mattress if we think the Dow is going to go lower. So even though this is only well, it's not only, it's $40,000 worth. Even though it's only $40,000 worth of protection here, we can easily double it and double it and double it again on the way down. And the thing is, what happens is as this layer goes up, as your primary layer goes up, you take that money, the theoretical money, you use it to purchase the next layer of the mattress, which is cheaper because it hasn't been hit yet. And then you put a stop on the primary layer, so if it pulls back, you make them. I must be doing a terrible job explaining it. It's so complicated, actually. Anyway, but the key to it is, though, that we're selling these puts. So we sell the short puts to help fund the cost of the long spread. So every month we sell these. This spread, 42 minus 16 is, I have no idea, is 36.26. So it's a $26,000 net cost. We sell $4,000, let's say, in the first month. So there's going to be a February, a March, an April, and a May. That's 4 sales that we'll be able to make. So we'll be able to offset about $16,000 of the cost. Now, what happens if it goes up? If it goes up, then what's going to happen is we're going to knock $16,000 off our $26,000 cost. And the net cost of this insurance, of 6 months insurance on the Dow, is going to be $10,000, right? Now, what happens if the Dow goes lower? If the Dow goes lower, 257, obviously, if this thing goes in the money, that means the spread is in the money. And then we would take the 257 and we would roll it to a lower put. And now let me show you how that works. And that's for every trade. I hate to say it, but for every trade, you should be thinking about all the possibilities of what could happen. so that you know what you're going to do if one of those things does happen. So we sold the February 257 puts, and they are now $1.50. Okay. Now I'm going to assuming they go in the money, I'm going to want to roll them. More or less, I'll be able to roll them to whatever is $1.50 now. So if we look at March, $1.50 is the 250. So we'll be able to roll them down $7 in 1 month. If we go to the next month, April, we'll be able to roll them down to the, holy crap, the 240s in April. And if we go to June, we'll be able to roll them down to to like the 225s. Okay, so we're at 262 now. 225 is like 20% lower. So if the Dow goes lower, 20, these are straight up, these aren't ultras or anything like that, so it's a straight up move. If the Dow drops 20% by June, then we have a problem with our short calls. But anything less than that isn't a problem. Now, it's a mattress play, so that means that if the Dow drops 5%, which would be $10, we would already be looking to add a layer to our hedges. If we add a layer to the hedges, then we're only half covered. And that means we could do a 2x roll to an even lower strike. And if the Dow does fall 20%, we would add another layer to the hedges. Now, if we're adding these layers to the hedges and they keep going in the money, that means we're picking up a $20,000 profit here and a $20,000 profit here and a $20,000 profit here. So before we even have to pay off the 225 short puts in June, we will have added at least 3 layers to the play, and we'll have 60,000, 80,000, whatever the hell it works out to in profits, and then we would have to pay some of it back to the short puts. So and it would have to be $40 lower to wipe out our profits on the hedge. And meanwhile, if we really thought the market was collapsing, we might buy even more hedges and whatever. So the point of a mattress play is that in a bullish market, though, that's the key. It drastically lowers the cost of your insurance. So on the assumption that this thing never pays off, like it hasn't paid off for 4 years, if shorting the Dow doesn't work out, then we're drastically reducing the cost, because every month we're going to knock about 20% off the net that we spent for the spread. So that's the logic of that play, is that we're hedging, and then we're hedging the hedge, but we know mechanically that we'll be able to roll those short puts lower and lower and lower. So, and by that time, so by the time we're at 250, we would certainly have added a 260, 240 spread, which would be half in the money. If we had a 260, 240 spread, and that's also added for the same price as this one was, which was 26,000, and the Dow continues to fall, because if it doesn't continue to fall, then these guys are going to expire worthless. And if it continues to fall, then this would go in the money, and that would go in the money, and we'd have $50,000. Then we add another one that's going to pay off $20,000, and then that would have to be in the money before we'd have to pay off the next roll. So every time we are forced to roll the short DIA puts to the next month and at a lower strike, we would then add a layer of the hedges. Now, the cool thing about that, though, is also as we roll this out, every time we add a layer, we put a very tight stop on the layer above it. So if this guy's up like he can make $26,000. So is that the right number? Yeah. So you can make $26,000. So let's say it's up $15,000. We would then add another hedge that also costs us net $15,000. We put the money back into the next hedge. That hedge would then protect us for the next $20 fall in DIA. And meanwhile, this guy would be rolled out to the 225s eventually in June. So we have $40 of spread to work with. and these guys would be in the money. Now, what we would do, and nobody saying it's up $15,000, we would then have a stop on this one at, let's say, 12.5. So what would then happen is if the Dow went up from where it had fallen, the short puts would expire worthless, no longer a problem. We'd have the lower hedge on the Dow, which is appropriate to where it is at the time, and this one would be off the table with a profit. So now the lower hedge that we bought would be net free because we bought it with the profits from this one and the expired DIA put. And I know that sounds complicated, and it will be. It's not. I certainly don't expect you to go, oh, I get that. It's because you either have to have an incredible, you have to have a chess mind, be able to think of all these different moves in advance, or you have to just watch it play out over a couple of years and see the little adjustments we're going to make. But I wanted to teach this. It's very tricky to teach mattress plays, but I wanted to teach this with both of these hedges because in this kind of market, in a market that almost never goes down, and plus look at today, we're going back up again, right? In a market that never goes down, these are the best kind of hedges to have. The hedges that don't cost you anything if the market stays up. This thing is too freaking bouncy to bet on big down cycles. So I hope that kind of explains it, but I obviously I don't expect it to be more than a sort of I get the gist of what you're trying to do. Add FNSR here, missed the initial OOP entry. Okay, let's see what they're doing. So where's the OOP? Okay. Well, yeah. Well, we're down. I mean, I still like them. They're again. This guy's at 19 FNSR, and we are. Well, first of all, where's my chart? Okay. FNSR. So nothing has changed. We're still going to need all these fiber optics and stuff like that to run the next generation web. So they're just down, and they're a little out of favor at the moment. But we're basically saying that we think they're going to go to. This is also a very light bet. 94 minus 53 is 41 minus 31. So we're in $4,000 net cash. We promised to buy 10 at 17. So net 18. So our worst case here is we own them for net 18. Once it's above 18, we make at least $1,000 because these expire worthless. So anything above 18 is profit for us. It pays, $1,000 comes back, and anything above that is profit. So right now we're $1 in profit. We're up $1,000 on this trade, even though it shows negative. If you liquidate this trade now, it's net $1,000 in our pocket. If you could expire the premium without paying it, and we're saying in a couple of years it'll get to 25. That's our max. At 25, we get back $8,000. So yeah, I wouldn't change it. I think the targets are fine, and it's great for a new trade because if you do it now as a new trade, it's $69.50 minus that is that you actually get a credit on entering the spread. So it's better now than it was at the time, but not drastically better enough for us to make an adjustment. Like sometimes, if it comes back down to 16, I'll probably want to roll to the $15 calls, and maybe even add more to the spread. But it would have to be down a lot lower than this for me to bother putting money into it right now because it's not attractive enough. Here's the lower line, but on the weekly view, you got to figure probably 15, certainly 14 would be your key support if it really starts failing. And again, my attitude about that is if it goes down that low, I want more. I don't want less. So at that point we'd go from 10 to 20. We'll be adding, not subtracting. So that's a really good stock. And again, long term, it's a long-term macro trend that this kind of company is going to make money in the Internet of Things, all that stuff. Yeah. Okay. Good. David's going to keep reading. That's excellent. FNS was caused downgraded by Goldman. Screw those guys. They're idiot. I mean, they're not idiots, but they purposely mislead people. They're evil. They purposely downgrade things that they want to buy. They want to put their customers into something they're very organized. They're like, we want to put our customers into FNSR after earnings, therefore we're going to downgrade them into earnings, and then we'll claim that, but they'll put a note out like right away on earnings and say buy FNSR, but they already know they want to buy it. They're just going to downgrade it first and then claim that they changed their mind after earnings, which puts people into it. I don't think they had earnings yet, but that's the kind of crap Goldman does all the time. So let's see. Yeah, March 7th. So timing-wise is exactly what they do. A month ahead of it, they're going to downgrade it or whatever, or try to chase people out of it to lower. There's no information. There's no reason. Nothing's happening. They're a top supplier in the optical component market. Company stock sells off amid iPhone X. Now, people worried about the iPhone X not being enough. That is insane. First of all, the biggest problem the iPhone X has is that the iPhone 8 is super popular and a lot of people are buying that. But in total, Apple sales and iPhone sales, X and 8, they're having a record quarter. To sit there and say, oh, the X is disappointing. I don't know that there is any particular projection saying the X should sell so much. And FNSR doesn't care. They supply to they're supplying to all the phones. They're not just supplying to the X. So, but the people who keep saying that, the X is missing. It's like, it's not missing. Apple released 2 phones at a time. They knew that like some people would buy one and some people would buy the other. I don't think they specifically knew exactly how many people would buy either one. What are your thoughts on BCG and ACAM? BCG seems to be buying out some small players and expanding, and ACAM seems to be undervalued. You have to remind me about that in chat. I can't start going over like every specific stock. But I'll be happy to take a look at them. I haven't looked at either one of those companies in ages. So Akamai, I used to like them, but I think they're pretty overpriced. I'll take a quick look at that just to see where they are. AK. So yeah, it says 40 times earnings. They're at $11 billion. And they're dropping $300 million to the bottom line. It's like 30 times. No, I don't. They're not growing that fast. 1.9 billion, 2.2 billion, 2.4 billion. That's 10% growth at best if you're being generous. The revenues are flat. What are you paying 30 times earnings for? I don't get that. There's so many companies that you could buy cheaply, and then people want to chase these things that are already bought by everybody. Look at FNSR, P ratio 10. This is why I like them. Look at their financials. Okay, that's not good. This is flat, but then here they pick up 1.2. They pick up 200, just a little shy of 200 million, which is 15% at least is the growth. Profit growth is especially exciting. Now look at that. That's your profit growth. They are booming it in profits, and their market cap is only where are they? $2 billion. $2 billion company. They dropped 250 million to the bottom line. That's why I like them. Okay, so when I'm picking a stock, I'm a value investor. I'm not a momentum player. Okay, so I could care less about these stocks. And to me, how could you ever say something's undervalued when it's trading at 30 times earnings? That's the antithesis of undervalued. Undervalued is this. It's like, what the hell don't people see about this company? And if you look forward to what the analysts are projecting for FNSR, they're projecting $1 in they're projecting at least average estimate is $1.40. So they're projecting basically they're going to keep up near maybe 12, 13 PE going forward. But it's a clearly growing company. They're in a fantastic space. Everything's exciting. That's what I like to buy in the company. If I'm going to be picking somebody up, I want to see a sector that's looking good, that has good prospects. I want to see a company that's undervalued in the sector, and I want to see like good earnings growth, strong profitability, good cash flow, things like that. That's when I call something a bargain. You know, there's a million companies that you can say, oh, they're great prospect, this and that. But, you know, if somebody's trading at 30 times earnings, it means a lot of people already made their bets on that one. There's not too much of an upside surprise you're going to get. Now, obviously, it's not always true because you got companies like Netflix and stuff, but I just don't play companies like that. You know, Netflix is still trading at 100 times forward earnings. But they keep raising their forward. You know, their forward always keeps looking better and better. Look at this pop, 225. That's a 10% pop on Netflix from the last earnings. And meanwhile, I mean, look at this. This is from they were 120 a year ago. 120, 250. They're up 100%. And so after being up almost 100%, they popped to make a full 100%. On earnings. So even though they're up 100%, earnings still gives them a 10% bump. That's incredible growth. But, you know, your guys aren't doing that. RB near 191 again. Wow, look at this recovery. Damn it. She just bet the farm on these recoveries. Up and see the Russell is still lagging. He's down here now. Is he an early indicator of weakness, or is he just, you know, lagging basically? And see how he's stuck at this line? So it does make for a great bet. I'm still, you know, you want to see some movement over here. So if one of these guys moves over, you can pick up the laggard if it looks like it's strong. But it looks like everybody's stopping at what's probably the strong bounce. What did we say the strong bounce was going to be here? It was going to be the 220 line. And look where we are. We're at 20. We hit the 220 line right there. That was the prediction for the strong bounce. And you know, actually, it's a good time to talk about that. What's the 5% rule? The 5% rule is basically that things move in 5% increments. The more liquid something is, the more the sub increments tend to take place. So in an index, 5% matters, 2.5% matters, 1.25% matters, and even 0.67% matters, or 6.25% matters. So half and half and half. If something's very liquid, each one of those matters. And then 10%, 20%, so on and so forth. Now, there's a subcategory of the 5% rule, though, is then what happens when you see these moves? When you see a 5% move, a 2% move, a 2.5% move, or whatever, you're going to see what they call a retrace, which is kind of like a Fibonacci retrace. And that means that in any move that you see, from consolidation to consolidation, not from spike to spike, but from consolidation to consolidation, you expect a 20% retrace of the move, so a bounce or a pullback, depending on which way it went, is a weak bounce, and a 40% is a strong bounce. So from 55 to 25 is 30 on the S&P. So if it's 30, 20% of 30 is 6. So that means you add 6 points to 25 is 31. And that's where you're going to expect to see a weak bounce. And you see how there's like some consolidation right along that line. And then from there, 37, which is this pink line, is going to be the strong bounce. And we calculated that one before, and this pink line turned out to be the bounce. On the Russell, we'll call it 20. Also, it's another thing. You want to round up to like strong line. So 20 is a strong line. This one we'd call 95. So you're falling 25 points. 25 points means your retrace is going to be 5 points. So 1600, you expect consolidation. You can see it there. And then 1605 is a strong bounce, and that's where it's failing. So we're failing strong bounces here. This one, obviously, 7,000 to 6,900 is 100 points. That makes it easy. 20 points, weak bounce, 20% of the 100-point drop, and 40 points is a strong bounce. So the NASDAQ is just over its strong bounce line. You want to see this guy over his strong bounce line, which was, what was it? 400 to 100 is 300. So 60 points and then 120. So this one over 120. So that's over the strong bounce. That's over the strong bounce. He's over the strong bounce, which means, again, we're lagging on the Russell, which means we're going to go long again on the Russell. And I made it 0502, so I'd stop out at 05, so I don't want to lose the money I made today. So I'm going to keep my stop here. Oh, come on, really? But this is why you don't do hard stops, because then it would immediately take your money. You just got to watch it and see what's happening. But as long as these guys look green and it's still going, making progress, he should be going up. And he's wrong if he's going down. So I'm going to let that go a little bit. But if any of these guys weaken out and start making a candle below the previous candle, then you want to get out. So in other words, the new candle should be above the previous candle. That's progress. If you're not getting that, you're not making progress. See, this candle's above, and this candle's above. So these are all positive candles, which means why is this guy not going up? He's being an aberration. But as long as these guys keep making those positive moves, he's going to get dragged up eventually. Remember, my stop is over here. But I'm not going to make that stop unless these guys go red. I want to see if two of these guys don't go red, I don't see any reason to stop out of this position. So let's keep an eye on them and see what happens. So it's a mental stop, but you want, that's just a line where you want to say, I got to really watch this thing and make sure I'm not getting screwed. Now, the Dow just turned red briefly, but didn't stay there. But it's struggling, so that's not good. I'm going to watch it closely. Then the S&P over here is very flat. That's not good. Now the S&P is a little bit red. These are all the strong bounce lines. So if they're failing, then you want to start going short. But we want to see what happens right now. Oh, come on. Really? Oh, now they're all red. Not good. Whoops. Forgot, got the wrong side. Red, red, red. Ugh, really? Had such high hopes. I'm just not convinced yet. The way it's moving, it doesn't seem like it's really falling. So if I was playing conservatively, I would have gotten out already. But see, I don't think he really wants to get. I think they're struggling just to get over their lines, but I don't think that's really stopping them. But we'll see. I wouldn't buy another one because it's too iffy. And what time is it? How far to the close? That's another thing you want to look at. It's 2:30, so we've got plenty of time until the close. See, that's the thing. You can give all the instructions in the world for something, but you sometimes got to go with your gut and think about what's happening. And what I'm seeing here is, it looks tragic on a short-term chart, but when you zoom it out, we're still pretty. These are basically still just running into a little bit of trouble as they're moving up, but it's certainly in the grand scheme of things. In fact, they're running. He's running into trouble exactly where he started the second leg down, but maybe he'll start the next leg up on that note. And the same thing for this guy, and not quite the Dow, but also the Dow still though. It's running into trouble right where the second leg consolidated. So maybe it's going to consolidate on the way up. Or maybe that's it. Or maybe it'll start falling again. Maybe it'll make a W and start coming down to the next leg here before it does anything else. So there's no real positive way to tell right now. We'll see what happens. Meanwhile, I lost $100 on that. But here I've got a new line to look at, so I can zoom in on this line. 1603. All right, and since I have one at 05, if I pick up one here, there. So now I've got one at now I'm at 0450 for an average. If we're below 3, I'm definitely getting out, but now I have 2. So I've lowered my average on the new ones. And now I only have to get back to 04 or 0420 to be even. Because I think that line, I thought that line would bounce. And even now I picked up like a few tenths of a point, mitigated my damage considerably. So it's like it doesn't have to get all the way even to get out and take your profit. So in fact, let me show you that, because watch, if I can see, I took that now. I'm back to 220. I maxed out at 255. So now I'm only down $35. So I've repositioned my long so that I'm in much better shape than I was. So now I'm back to 1. I've only got the 1 long position, and it's not damaging me as much, and I can still quickly make back my money. So you don't need to make all your money back when you add one, and it makes sense, because all I did is say, look, I'm hitting this line. If it holds that line, then it's going to bounce higher, and I'm going to get my money back. So why wouldn't I add another hedge there, and I'm going to stop out both of them if we go below the line? But while it's at the line, and I didn't see these guys falling too fast, it was worth adding one at that point. So now I'm at 225, so 255 is where we started from the second set. But that's what I mean. You can't fixate on a chart when you zoom in. Oh, and again, this one's still zoomed in. When you're zoomed in, you got to realize it's a very, very different picture than when you zoom out. So you've got to keep that in your head. You can't get yourself fixated on a chart, on the candles, when this little thing is, it's like, it's like zooming in really, really close on a bug and going, ah. With nature films, they like show you the bug and like it looks like it's Godzilla. That's what this is. It's like these are nothing moves. These are like little teeny incremental moves that don't prove anything. So like I said, I wanted to see those positive candles, but those positive candles were on a very, very tiny spot. And so the overall picture wasn't really getting hurt that much, even though it looked like the candles were turning ugly. But it wasn't enough. It wasn't ugly enough to make the picture. Because for this candle to really start damaging the picture, it's going to have to go way down here to make the bigger picture look bad. So meanwhile, now I'm back to zooming, because I still would like to see some positive moves here. And if I'm not getting it, I just get out. I'm back to 250. So no harm, no foul now on this thing. 250 is right there. So this is back to even on that thing that we just did. And I'm looking to see, I want to see these guys break up at this point. Otherwise, I think they're forming a kind of little top. And just to the point where I say it's not worth me, sitting here and staring at the thing, basically. So another thing, by the way, day traders, you got to value your time. You got to say to yourself, is this worth me sitting here staring at this thing so I can make $10? No, it's not. It's like, go get a job. Unless you think there's going to be a really good move, that something good is going to happen. I think we might get a nice pop into the close, but I would rather see, I would like to see a safety cushion come in before I like walk away and leave the thing. So I want to see a much better positive move out of these indexes than what we're getting. But you see what I was thinking? This candle is starting to look good. That's looking healthy. This guy's not, though. This guy's not. We're still waiting. But they're green. Not healthy, but green. But he's healthy because he's above now. So he's currently, the way the candle works is if it's a green candle, then your last bids are here. And this is the part that's moving. So the opening bid was here. The current bid is here, and it's always going to be the current bid showing the width of the candle. If the candle goes red, it means the current bid is below the opening bid. So people are bidding this up. So that's the NASDAQ getting bid up, and the NASDAQ is where the problem started today. And we're waiting for these other guys to get a positive bid over these lines. And now the Russell's getting bid up, and now we're at 305. So now we made $50. So now I want to protect my 300. So now I'm moving my stop up here, so I protect the $50 we just made. Or maybe here, I don't know. Oh, but he made it positive. He's getting positive. So now, even though I had my stop here, now I'm like, oh, he got positive. Look at that. Now a new candle. So now this candle finished at the top. This candle's forming, obviously, at the same place the old one left off. And now we definitely want to see some green. And if we don't see green, I say get out. So red, 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 done. And we're at 280. All right, so all that work was for $25 more in the end. You know, but look, that's how you play the futures. And you know, I play these things with 10 contracts and stuff. But the point is, you got to play with an amount that makes you comfortable and makes it worth your time to do it. You know, that's key. But you got to have that discipline. You got to say, look, I'm going to say, like I just said, I want to see these positive candles forming. But now, if they can't make an up move from there, it's over. I just want to get out and be done with it. Doesn't mean I changed my mind. I still think we're probably going to go a little higher into the close, but we'll see what happens. But if we start failing, now we know what the strong bounce lines are. We could watch to see if they start failing. If strong bounces start failing, we could make a negative bet. So, you know, although like it is, the only time I'm ever act technically is with futures, because you have to, because that's basically the futures completely run by technicals. All right, what else? Why don't we... what else exciting? All right, did I do a trade today? Did we add something today in the I don't think so. We did a short term. Let's take a look yesterday, in fact. That's a good idea. We did some short-term portfolio adjustment. Options opportunity portfolio adjustments yesterday. So let's take a quick look at those. What happened is in the options opportunity portfolio, we did the hedges a lot sooner than we did with the in the long-term portfolio. We didn't hedge at all because I was saying for the last week or so that our huge amount of cash was our hedge in the long-term portfolio. We didn't need actual hedges because we had so much cash. Then I decided to do the mattress plays just the other day because I said, you know what, it's good to have something in the short-term portfolio, and it's a good lesson to start teaching this year as mattress plays, because if we have another up year with a runaway market, it's good to know how to do those kind of hedges. And it does take a long time to teach, so better starting than not. So in the options opportunity portfolio, which is right here, okay, FAZ down here, and the adjustment was FAZ is going down and down and down. We came in around here at over, around 11, I guess. So we rolled the $10 calls, which were 32 cents, to the April 10 calls. I'm sorry, to the 10-11 spread. That spread is, so these guys are 32 cents. We're cashing them out. And we're rolling them to 68 minus 40 is 28. So we're rolling them to an equal number of, to an equal priced spread. So we're taking these $10 calls that they're not likely to make any money right now. We're moving them to further out in time calls, much further out in time, 2 more months, of the 10-11 spread. So still the same spread, basically. It's still the same strike, but for the same money. And now we're doubling the amount of money. So we're taking no extra, we're not spending the 640. It's going right into this first 20. But then we're spending 20 more times 28 is $560 more. Okay, and I guess that probably pans out if you do that. So we're spending $560 more, and we have 40 times the dollar is $4,000 worth of spreads. And I say here, we began at net 1,300, and we're putting another 480 in. So we're in the $4,000 spread for 1,780. So we're still going to make 100% on this hedge if it works out ultimately. If it doesn't work out ultimately, we're in it for 1,780. That's our insurance cost against the portfolio. And now that's taking us all the way through April. That's protecting all of our long-term positions in the options opportunity portfolio. Well, this one and TZA are doing that. And it says if we buy back the short calls for 300, if it goes up, we still have the short February calls that are left over. Where are they? So these are leftover calls. They're double covered, but still they're 11. So, we don't want to go too crazy. So there's a buyout. If these get to 20, I think, we said we're going to buy them back. Then that would then cost us whatever I said. If we buy back the short calls for 300, what did I say we're going to buy them back for? I stop at 20. Actually, it's 400. I'm incorrect. So if we buy back the short calls for $400, and 20 of them, then it would be 20. Then our net in would be 2180. I was wrong by $100. So net in would be 2180, and we would then get 4,000 back on 2180 if we go to 11. So it's still a good trade. It's only 100% if it goes the way we expected it to. And more importantly than that, TZA is our primary hedge. Our primary hedge, we got much more aggressive. We rolled the TZA April 11s to 40 of the July 9/12. So here we went down in strike to 9, which is in the money, and we sold the $12 calls. So now we have 40 times 3 is $12,000 worth of protection that we've got. And we're putting a stop on half of these ones now because these are way out of the money. The April 15s, they're way up here. We don't think they're going to get hit. They're so far out of the money, we just put a stop on them rather than on half of them because we don't think they're going to expire in the money. And if they do go in the money, we're going to net back $12,000. We spent $4,500 initially. Now we're spending $250 more. It's $4,750, and it's $12,000 spread. So we have a $7,250 upside on this one. So $7,000 here, a couple of thousand here. So we have a $10,000 downside protection using these two hedges so far. That's in the options opportunity portfolio. So 10% of our portfolio we would get back in cash if the market collapses. So our goal then would be not to lose more than 20%. Oh, and by the way, what's the logic of that? If you have $100,000 and you lose 20% on your positions and you gain $10,000 on your hedges, you're netting back $90,000, right? But if the market fell 10%, well, there'd be more than that. But if the market fell 10%, then that means that the $90,000 net that you have now in your portfolio, you can buy the same 100% of the stocks because they're now on sale for 10%. So you only need $90,000 to buy $100,000 worth of stocks. So stocks that were $100,000 when you started. So what we look to do is mitigate about half the damage on the way down. So if the market falls 20%, and our $100,000 portfolio is worth $90,000, that means now we have $90,000 to buy stocks that were 100 and are now on sale for 80. So our relative buying power is better in terms of stock, which was our goal. And that's the thing, you have to realize you're in an ecosystem where our goal is to be a long-term stock investor. Therefore, we only care about the relative buying power of our dollars versus stocks. That's why I was bitching about the dollar take, because when the dollar gets weaker, we can buy, and the stocks get stronger, we can buy less stocks for our dollars. And that's not what we like. We like to be able to buy more stocks for our dollars. And that's what happens when the market crashes. You don't have to preserve all your capital, just preserve more capital than everybody else who is stuck in the stocks. And then you'll be able to buy those stocks cheaper. Now, this only works if that's your intention. If your intention is to cash out and go buy houses, that doesn't work. But if your intention in a closed loop system is to preserve your capital so that you may buy more GE than you could have bought before GE fell 20%, that's the way to go. So I don't need to have, so if GE was 20 and now it's 16, and I had $20,000 to buy 1,000 shares of GE, if now I have $18,000 and it's at 16, guess what? I get to buy 1,100 shares of GE with my $18,000. So I'm buying 10, 15% more GE than I could have bought before. That's my goal. My goal was to own GE. My goal wasn't to have $100,000. My goal was to own 1,000 shares of GE, 1,000 shares of this, and 1,000 shares of that for the long term. That's why this strategy is great. But people are very short-sighted and they only care about, do I make money today? Did I get this? What's my net portfolio value? But if you're trying to build a portfolio over 20 years, a long-term portfolio, what you care about is how much more stock can I get? Where can I get more stock? How can I get stock cheaply? So that being said, then GE, which did go down considerably since we went in, we came in at here about 1850 and it's now 1650. So it's down about 10% or more. We had the 2020-18 calls at 250, and we're rolling them to the 2020-15 calls at 390. So we're paying 140 times 20 is 2,800. We're buying back though for 1,500. We're buying back the short calls, so now we have no cover. And it's not that we think GE is going to go to 25. It's just that if we have these short 25s and GE pops back to 20, I can't sell the 22s for a good amount of money because I already have the short 25s. So we've now ratcheted down our expectations of GE. So when GE does get back to 20, we will very likely sell 22 calls, and we want to get more than 75 cents for them. So we're just waiting for the bounce, and then we'll sell. But we'll see what happens. Unfortunately, I've got this accounting scandal with the SEC, and that may take a while to resolve. But when it resolves, we'll get it. But I really have no problem being long GE at this price. It's crazy. IMAX is another good one. And again, we took the opportunity. When it goes down, we came in over here at 23. It's down to 20. So we take the opportunity to increase our position from, we had 10 spreads, and now we're buying back at 10 spreads, and we're moving into 15. But here we're keeping a spread of 19.25. So we're 19, we're in the money, and 25 is up here. That's our goal. Very conservative play, and we're spending $2,050 on top of. See, when we put $1,150 in, and we were going to get $9,000 back, that was like going to be fantastic. But that's only if it works out perfectly. Didn't work out perfectly, so now we spent $3,000 and we're going to get $9,000 back. That makes more sense. 200% return is more likely than 1,000% return. So we're basically, now we're into a 200% return play. It's a lot more likely to hit. We have much lower strikes, and it's a better play. It's not likely you're going to get 1,000% return. We play for it because if it happens, it's great. But if it doesn't happen, it's not a big deal. We take the, we adjust our trade, and if we believe in it, we put a little more cash to work in the trade and whatever. But still, we're only putting $3,000 to work in a $9,000 spread. It's not a terrible thing. But that's the way it goes. So we start out with a small position, and then we work our way up to a stronger position. No comments? Did you guys stop commenting? Okay, fine by me. All right, we're going to wrap this thing up shortly anyhow. So somebody said RB, so let's take a look at RB. Whoa, look at these guys go. He's still lagging the Russell. See, he got stuck at this 50 line, so it's not an exciting looking long right now. So all we got really is well, the weak bounce is relative because you read for the day, read for the day, flat and up a little bit on the Dow. This is basically a flat day. So there's nothing really exciting going on here. So gasoline, holy crap, 192. God damn. I don't know what they were reading. I mean, the demand really wasn't there. $66 on oil. This is going to destroy the economy. Look at the dollar, 89. That's awful. Silver blasting up 1760. Look at silver move. Ah, what a great trade that was. And coffee, how's coffee doing? KC. There's coffee. Hit good old 123 again. So now what do? We wait for it to come back to 121 or 120, start going long, sell it again at 123. It's a very reliable trade. So gasoline, oh yeah, I was going to check the EI. So let's take a look at the petroleum status report. And we'll look at see if there's anything weird going on. That's all. Make sure we got the right one. January 19th. All right. So what happened? We had a 3 million barrel build. Excuse me, in gasoline, and there was no change. Oh, in fact, they actually they supplied less, 200,000 less per day. That's not nothing. That's 1.4 million a week. They supplied 1.4 million barrels less for the week of gasoline. Oh, but here's what killed them. Look, they exported less also. For whatever reason, they exported a couple of 100,000 barrels less of gasoline distillates. So that's really what killed it. Was that this lower export number was bad. Now the total. Oh, I said it's net import. Yeah. So there's your big difference there. Is we exported less, even though they refined less, they exported less, and they also refined less distillates too. See that? That's 957. That's 700,000 there and 1.2 there. So 2 million barrels less were produced. And what is this number? 1 million, and then 700,000 barrels less were exported than last week. And that's basically the tail of the tape. There's really not much there otherwise. Meanwhile, oil is up at 63. It was 52, so it's up about 20% from last year. Gasoline, though, 232. Oh, actually, it's not so bad. That's retail prices. So gasoline was 232 last year, and now it's 256. That's not as bad as I thought. It's only up 15%. So gasoline was kind of expensive last year this time of year. You know, we're looking at the wholesale prices as retail prices. They don't tell you the wholesale price last year, but we can always look. So honestly, it's not that much to complain about. I mean, oil's up 20%, but gasoline's not. Now, meanwhile, what does that mean, though? If oil's up 20% and gasoline is only up 15%, that means the refiners are getting squeezed, right? They're making less margin than they made last year. So then you want to look at a company like Valero and contemplate how their earnings are going to look. VLO. We played them last year. Wow. I would have to call Valero short. Their margins are lower than they were last year at this time. All right, in this particular month. I'm not sure how the whole thing shook out, but basically, at this point right now today, their margins are lower than they were at this point last year. And last year they were priced at 70, and now they're priced at 100. So they're priced almost 50% higher than they were last year. So Valero is a good short into earnings. And let's try. I tell you what, we'll look at a play on that. Where is it? Oh, here you go, Valero. VLO. Okay, Valero. They are making more money this year than they made last year, theoretically. Their financials. See what's weird about them, though? Look at this. They did 130 million in 2014, 87 million, 75 million. Yet, here, their profits actually went up when they made less. So they had better margins last year. Not last year, I'm sorry, in 2015. It's more about, for them, it's more about the margin. It doesn't matter how much they sell, it matters how much their margins are. In 2016, they did not have great margins, and quarterly, they went from, here we are last quarter. So they were 20 in revenues in this quarter last year. We're assuming they're probably going to be closer to 20. I think they're going to go down. They're certainly going to go down from last quarter. Profit-wise, their profits were 6. Here they were 840. So they had an outsized quarter last quarter, and obviously people are extrapolating they're going to keep doing it. It's not likely. So, look at them popping. We're popping. Everybody's popping now. All right. Trade. Seeing the Russell's still slow. You can still play it. It's way lagging the other guys. What was I going to say? Valero, right? Trade all products, Valero. So with Valero, you want to see if there's an opportunity to do a short. Oh, earnings. When are earnings? Earnings are going to be February 1st. Okay, great. That's what, like in a week? So that's a good clue. And that means that we could sell the February calls. So we could sell the 100 calls. It's not very sexy though. It's only $1.20, and it's a little risky. I mean, what if they go up 10% and then you're screwed, right? What about the Marches though? Now, since there's no earnings again until June, there's no sense. It's no different selling the Marches and the Februarys, but you get more money for the Marches. Ooh, not enough though. Nah, sorry, no trade. It's not enough money to make it interesting because again, what if it goes 10% against you? Then you lose $750 if you sell the 100 puts. I don't want to lose $750. I don't feel so strongly about this trade that I think it's worth risking losing $750 on an earnings call. You don't know that you're going to lose it, but you just might. Is there a way to do a put spread? If I do the 100 and the 90s, no, that cost me $5. That's a lot of money, and so it's only a 50-50, and I have to be right. I don't like trades where I have to be. I don't like trades that only pay me even money and I have to be right, even though I probably will be right. Why should I play it for even money? I like trades where I have a 2-to-1 advantage. This is not giving me that. These margins are not exciting. These options are not exciting enough to make it work. So it's a shame because I really do feel strongly about this. I feel strongly about it. I think Valero is going to miss and fall below 100, but it's not really worth playing. Certainly not something I would put. It's not something I would want to risk in the options opportunity portfolio to make 1,000. Do I want to risk $2,000, $3,000 loss to make 1,000? No, that's not how we build a portfolio. I build a portfolio by risking 1,000 to make 3,000, and then hopefully I'm right half the time. If I'm right half the time, I lose 1,000, win 3, lose 1,000, win 3. That works out. But not to take 50-50 chances. That's not what it's about. And that's what you have to also learn, that discipline. You always have to, if the reward isn't at least double what the risk is, don't play. Not worth it. What is he saying? My Achilles heel Valero is still holding on to my butterflies. Whoa. That was weird. Okay, so Lerner says, my Achilles heel Valero still holding on to my butterfly short call we've discussed before. Oh, this might be your time. So, oh, they're doing a stock buyback. That sucks. No, I would go. Seriously though, I don't think the earnings are going to disappoint. I think that might be why they're doing the stock buyback, because they want to mask. It's what, 5%. So they're buying back 5%. I think they want to sort of cover up the poor returns that they're going to be showing. I don't know what your short is, but I think I would be, I'd be probably playing the 97.50 short calls in March. There's no reason to play February. Take the extra premium for March and see what happens. I mean, if you want to get bailed out, that's probably one of your best chances. I can't see how they don't disappoint. I really can't. I think that'd be very odd. The March 87.50s are. This is Valero 97.50s. That's why I was like, how could that be? So they're like 340. I don't know where you're at, but I would play that, frankly. If I was behind and I wanted to get even, that's where I'd look. Still risky, but probably. I just think I think it's one of these cases where I think it's probably a 2-to-1 chance that I'm right, but then the risk reward of the trade isn't even 2-to-1, so I wouldn't play it. But I really feel strongly that there's no way they're going to make over. I don't see how they justify $100 based on the fact that the spread between the cost of oil and the cost of gasoline has narrowed significantly since last year. So they make less money per barrel that they open. There's nothing they can do to avoid that. There's no magic things they can do. That's just the way it shakes out for them. All right, so looks like the markets are nicely recovering, but holding, holding flat. I'd say it's a toppy looking day, and if you look overall at the longer term picture, let's take a look at that for a second before I sign off. If we go to like dailies, it's a little, see, especially on the Nikkei, you can see that there, getting to be a little bit like a toppy kind of action. And for Christ's sake, at NASDAQ 7,000, you would think they would top out a little bit. And then you got to say, well, which indexes had the biggest run since this November here? And then you just got to run the numbers. So you got to say this one is a 10% run. This one is 23 to 26. Is like 15% on the Dow. The S&P is a little bit, about 12%. And the NASDAQ 62 to 69 is 7, is about 12%. So the winner is the Dow, and that means the Dow would be the one I would most likely want to short. Now, there was a good chart today. That was this one. And so what we want to do is look at the Dow and say, okay, where are we? So who had earnings? I don't know this, but you want to say who had the earnings, how did they do, and then think about it in terms of who's overbought, who's oversold, who's got earnings coming, who are we past. We're past JP Morgan, wherever they are. Is this alphabetical? No. How annoying. I can't tell you. We're past GE. But now, in the Dow, the most expensive stocks count the most. So Boeing's earnings are much more important than anybody else's. United Health's earnings much more important than the rest. 3M, very important earnings. Apple, very important earnings. Goldman, very important earnings. We passed Goldman, though, already. So you have to think of the weighting of the index, and the weighting is price weighted. So we have to look at each stock when they report, how much money they're going to, what they're reporting, and where we think they're going to come on the earnings. Now, Valero is not in the Dow, so that's not really an issue. But Exxon, whatever, Exxon has refining also, so they're going to be affected. Chevron has refining, they're going to be affected. But that balances out for them. That's why they have refining operations, to balance out the oil, because usually when oil's cheaper, the refining operation makes more money because it takes time for gas prices to come down to match oil. So the trick is to look at the Dow and think about conceptually, are the upcoming earnings indicating a positive or negative for the Dow? And if we look at these earnings, and here you just have a quick overbought, oversold, they're generally, this is oversold. Everything's overbought. This is all this red area is overbought. It's just a question of how overbought are they? The only thing that was oversold is GE. And everybody else is basically overbought. So the question is, how forgiving are we going to be on earnings? And are the earnings that are coming up enough to knock the Dow lower? And then how much lower do we think it'll go? So it's all kind of quantifiable, and that's something I want to probably look at tomorrow. I like this chart a lot, though. It's a good starting point to think about where it is. All right, so that I think is where we're going to wrap this up. So we're going to think about the Dow. It obviously, we did it for mattress play. It's already a short we're looking at. I definitely like the Dow's for a hedge. Any thoughts on PCG? No, I have no thoughts on PCG. Remind me in chat, though, if you want me to take a look at it, I'd be happy to. I really have I haven't looked at them in a while. I don't know what they're doing. I don't generally like the utilities because, their P is fantastic and all that. But my overall take on the utilities is that all these people moving to solar are coming off the grid, right? So the utility companies can't get more customers. They basically have a zone, and they're in the zone, and everybody in the zone is their customer. So when they lose people to solar, it's a big deal. They don't get these customers back. They're gone. They no longer can service them. Now they have to service less people with the same amount of infrastructure and cost. So I think that's long-term damaging for the utility industry. I also think they've got coal and nuclear plants that they have to phase out, and that's going to cost them money over time. Phasing out doesn't do anything for you. You spend a lot of money to clean up a site and decommission a plant, and there's no downstream revenue from it. In fact, you're taking away downstream revenue. At the same time they decommission their fossil plants, they've got to build solar plants and other infrastructure and natural gas and solar and wind and eventually fusion. They're going to have to spend a lot of money to put in new energy sources, and meanwhile, you've also got the problem that LED lights and things like that are lowering the consumption of energy in the home. Not only that, though, but like new washers and dryers. We just did this the tariff on washing machines. The new washing machines, they wait until like the electricity is cheaper to turn themselves on and things like that. They also use a lot less energy. All the appliances are using less energy, but mostly it's the light bulbs. Such a difference in these LEDs. And more people have moved to LEDs. You don't even buy regular bulbs anymore in the store. So I don't like the whole long-term outlook for the utility companies. Even though they're still great businesses, huge cash cows and all that, I don't see them as really a big growth thing. Anyway, 95 short calls. That doesn't make any sense on these guys. Can you pick an upside target for Cisco and how you think it will react on earnings on the Dow? I like Cisco long term. The Internet of Things stuff and all that. And as to earnings, though, I don't know what they're doing right now. CSCO. And again, it's one of these things where they were 30 last year. Now they're 42. They're up like 50%. And if you look at the numbers on them, look, for Cisco, that's a lot of money when you're paying 20 times earnings. 9 billion, 10 billion, or 11 billion, back to 9 billion. They're not growing revenues revenues flat, earnings flat. So I like them as a long-term prospect, but I wouldn't buy them now. We haven't bought them for ages because they're too expensive right now. This is 11, 11.9, 12, 12.1. They're not selling more stuff. They're not making more profit. They're not doing anything that justifies having a 22 times valuation. They're just overpriced, just like most things are overpriced. So I wouldn't chase them I hope they miss, and I hope they crash, and I hope they go back to 30. Probably not going to happen, so I probably won't be in Cisco. But I don't buy things that aren't on sale. That's the key. If you only buy things that are on sale, you'll do a lot better in your portfolio. So my upside target is where they are now. I don't think they deserve to be any higher unless they really come out with some surprising information. So and now the thing about Cisco, though, is a $25 stock. It has no impact. Not 25, sorry, 42. As a $42 stock, has very little impact on the Dow. If it goes up 10%, it's only moving $4 on the Dow times basically it's like 8.5 Dow points per dollar. So 32 points on the Dow would be your maximum positive impact. And these guys aren't going up 10%. They're much more likely to come back and test the 50-day moving average at 40. So I don't see that they're going to come out with anything that justifies this kind of increase. It's the same stock. I mean, look at the numbers. Financials. Quarterly. Okay. Why don't you there? So last year in Q4, or in the one that in the whatever, it's still Q4, whatever you want to call it. They had 11 billion sales, 2.3 billion in profit. This year they're going to have the same freaking 11, 12 sales. They're going to have the same 2, 3 in profit. But this year you're paying about 35% more money for the same sales and the same profit. Why? Why would you do that? I wouldn't do that. So my target is it's overpriced. I'd be very happy to pay. I wouldn't be happy. I'd be happier to pay 38. I would be happy to pay 33, which is where they were last year after announcing the same numbers. But I think all this other stuff is bullshit. All right, so that's where we can wrap it up. Cisco is bullshit. I love Cisco. I love them long term. I love this company, but they're overpriced now. That's all. They're just not on sale, so why would I buy it? You know, I see houses I love, I see cars I love, but you know what? If they're not on sale, if they're not some great price, businesses, I buy businesses. If I see a business I love, it's got to be cheap though. I love lots of stuff. Like it's got to be cheap. That's when you buy it, when it's on sale. If it's not on sale, wait. There'll be something will be on sale that you'll like. Don't worry about it. All right, that is a good place to end this, and I will wrap the thing up. Oh, I don't know how to wrap it up. Oh no. What did I do? Wow, seriously, I have no idea where this webinar is coming from. Oh, I see. It's this panel over here. Ha! That was very confusing. I collapsed the panel and I forgot. All right, guys. Thank you very much for coming, and I will we'll do it again next week. All right, take care.